Good to see you. Thanks for having me. So I'm Thomas Rice. I am the portfolio manager at the Global Innovation Share Fund at Perpetual, which I'll provide an overview of today. Please note this is general information only and isn't intended to be financial advice. If we advance to slide 3, so let's start with what the fund is and what I mean by innovation. So the core idea behind the fund is really that to outperform, you need to find misunderstood and mispriced stocks. And the best way to find misunderstood and mispriced stocks is to focus on areas where the world is changing. So the inverse of that idea is that areas of the market with little change tend to be well understood and fairly priced. So the fund's really a fundamental, bottom-up, global stock picking fund, first and foremost. But we choose to spend our time just trying to understand that change in innovation that's going on. It's also a global strategy. So right now we're underweight North America because we're finding better opportunities in Europe and Asia. It's also a lot broader than technology. So recently we've seen our weighting in information technology and communication services decrease, but that's just because we found more opportunities in industrials and healthcare. And that positioning is really driven by stock-specific opportunities. If I talk about the team, so I run the fund. I have 18 years in markets, first at PM Capital for 11 and a half years, part of that with Tim, and then 7 years at Perpetual since 2014. I'm supported by 2 highly experienced analysts, Andrew Plummer, who joined Perpetual from Five Oceans, and Mark Skurnick, who joined Perpetual from Fidelity in Hong Kong. So if I talk about performance, the fund was started in June 2017. I'm happy to say that we've delivered strong returns for investors to date. So it's 35% over the last year to August, 25% since inception, which has outperformed the MSCI All Country World Index by 11.6% per annum. We've been around for 4 full financial years. So the next slide goes through how that looks on a per financial year basis. The last 2 years have been particularly strong with a 37% return in 2020, 38% in 2021. And that return's been driven by a wide variety of stocks, which we kind of show in this next slide. So what this chart shows is the top 10 contributors to performance in each financial year in the light blue. The dark blue is then the performance contribution from the 11th biggest contributor onwards. So you can see in 2020, when the fund returned 37%, the biggest contributors were Zoom, Virgin Galactic, and Axon Enterprise. Zoom was the biggest contributor because we made that the biggest position in the fund in March 2020. We saw COVID, leave China, it was beginning to spread through Europe. We were worried about the risk that would get a lot worse in the world. We were looking for ways to hedge the portfolio. Zoom, which we already owned, we made that the biggest position because we thought that would be a good COVID hedge, which turned out to be true. But you can see even in that year, that was less than a third of the contribution, and there was a long tail of other stocks. In the 2021 financial year, when the fund returned 38%, the biggest contributors were Twist Bioscience, a synthetic biology company, Boohoo Group, a UK online retailer, and Vestas Wind Systems, the largest wind turbine manufacturer in the world. But you can see from that dark blue bar that 40% of the return came from stocks beyond the top 10 contributors. And one thing I try to do is really keep a portfolio that's fairly diversified. I mean, I think a portfolio is a lot more robust when you have a lot of different diverse ideas driving performance rather than just having 1 or 2 big thematic, bets that the fund is making. So to give you an idea of what I look for in a stock, I want to talk about Axon Enterprise. That was made the top 10 contributor list 3 of the last 4 years. It's the biggest contributor to date. So what is this company? You might know it from its first product they came out with, which is a taser. I first came across it in April 2017 when I saw this article in the top right. It's a Taser International, now Axon, to offer free body cameras to every US police officer. That was also when they changed the name from Taser to Axon Enterprise. As you can probably guess, Axon is all about police body cameras. If you ever see a police officer wearing a body camera like the one in the bottom left, I mean, that's Axon. Next time you see body camera footage, you'll probably notice the kind of Axon labeling on it that you see in the bottom right there. So why was it interesting as a company? There's a few reasons. So number one, Taser itself is a really strong business. It's a very nice industrial business that grows high single digits. It's got a lock as a less lethal force option for police. And the second reason is all about AI. So we'd previously done a lot of work understanding what machine learning was, what AI was, what you could do with it. One of the key takeaways from that was that, one way to think about AI is it lets you solve problems you couldn't previously solve with computers. So image recognition, voice recognition is a big part of that. It's why Facebook years ago started automatically detecting faces in photos. It's why assistants like Siri emerged. So for me, we were kind of looking for interesting data sets that that could drive AI. And we thought, so when I saw a company with that was a leader in police body cameras, I thought that's an interesting data set. Maybe you can add additional AI services around that. And as I did more work on that, actually, if you go back a couple slides, as I did more work on that, I realized that Axon was onto this opportunity already. They were miles ahead of the competition. They had already set up an internal AI division. They had launched a cloud platform to store the body camera footage. Whereas the competitors weren't looking at it at all. The major competitors sold body armor, holsters, and body cameras. So it was an extra SKU. These guys were focused on it. So what were they doing? So the first thing they added was automatic reduction. When you release body camera footage, you need to blur faces and the like on laptop screens. That was a very manual process where you draw a box over an image and then move it, move a few frames and manually move it. With AI, they could make that automated. So they did that. They followed that up more recently with priority ranked audits, which is the next slide. If you think about running a police force, every day you have thousands of hours of footage being uploaded. No one can review all of that. So using AI that now automatically flag that, it adds transparency to policing. The long-term vision of the company is all about automating more of police work. If you think about 2/3 of a police officer's time is paperwork. That's on the next slide. It's so they're aiming to automate more of that. So they launched a business called Records Management, which really takes the idea of using that body camera footage as the heart of a police record. That's now being sold. They're adding automatic transcription to that. And if you go to the next slide, you can see that if you bought the stock when they changed the name in April 2017, you would have done very well. We bought the stock when the fund started in June 2017. So that's why it's been a big contributor to the fund. And it's really, Axon's really a great example of a company with a management team that understood the technology landscape, how that was changing, and really adapted their business to take full advantage of that. Okay, so that's been a big contributor in the past. I want to talk about what I'm finding interesting today. One of the most interesting companies I'm following right now is Opendoor, which I think has the potential to be a truly disruptive company in the real estate industry. So what are they? They're essentially the leading iBuyer in the market. So let's say you're a homeowner in the US and you're looking to sell your home. Often that's a very cumbersome process. It can take a few months to find and appoint an agent, make small repairs, clean up the house, have open homes, have lots of strangers through your house. At the end of it, you don't know if it's going to take a few months or a lot longer. You're not sure what you're going to get. You'll typically pay a US broker a 6% commission for that. It's a painful process for a lot of people. It's a process that hasn't changed in a long time. The idea of iBuying, and Opendoor is the largest iBuying company, is that instead of doing that, you go to a website, you put in your address, you answer a few questions, and then via a smart algorithm, they'll make you a cash offer within 24 hours. And if that's accepted, Opendoor will charge a 5% service fee, which is comparable to what brokers charge. And you can choose when the sale closes. It's a much better experience to sellers, and it's a part of the market that's growing really rapidly. So that's the way to think about Opendoor. It's really a core service about making a better experience to the sellers and then charging for that. So on the next slide, if you think about the key questions for a company like this, it's really can you price houses appropriately and manage that risk? It's important to note that algorithms for pricing property are not new. I mean, when I used to run an Aussie long short fund a long time ago, we used to own RP data in Australia, which values every property in the country on a daily basis. They do that for property indexes and automatic loan approvals below a certain LVR. Those algorithms were good enough for that purpose, not good enough to be buying properties. What's changed is the rise of deep learning, where a company like Opendoor can now look at significantly more data points and come up with an accurate estimation of a value of a house. So it's not just things like lot size, number of bedrooms, but it's granular data like the type of benches they have, the type of roofing. There's a couple of this with local experts in the process, particularly early on, which really helps capture the nuances of a local market. And what they found is that over time, as they make more offers, as they collect more data, the algorithms get better, and that really drives profitability at a local market level. So the next slide. So this is a company we've watched for a while, only bought that back in May. We've since made it the largest position in the fund. I think will be a meaningful disruptor in the real estate market going forward. And yeah, so very excited about the future of that company. The other one I want to briefly touch on is GXO. So it's the second largest contract logistics company in the world. Three major trends are making that interesting. Number one is the rise of e-commerce, a very long-running, ongoing trend. E-commerce penetration in the US was 6% a decade ago. Now it's 21%. That e-commerce growth is leading to greater logistics intensity. So if you think about shipping out packages to a store versus individuals, that's about a 2 to 3 times increase in logistics intensity. And then the third one, on the next slide is really increased complexity within warehouses. So we're seeing increased use of robotics, goods to person systems. So there's robots that take the packages to the pickers and packers, advanced sortation systems, et cetera. And that's all leading to greater outsourcing because it's harder for a company that's focused on their consumer brand and their goods to manage all that complexity. So we believe as it becomes more complex, it drives outsourcing, and some of those efficiency gains will accrue to the outsourced partner, GXO in this case, which will drive strong returns over time. So on the next slide, you can see that only recently listed. It was owned by a company called XPO that spun them out. We did own XPO prior to the spin out, but now we own that directly. I think that has a long, bright future ahead of it. If you look at the top 10 in the portfolio, I won't go through all of these. I just want to point out that it is a fairly diverse mix of companies. Opendoor and GXO you can see as number 1 and 3. It's also not only newer companies. We own Siemens as our 4th biggest position, which is an industrial conglomerate in Germany. What we like about that is it's got a very high quality, and highly valuable software business at the core of it. Okay, so hopefully that's given a good overview of the fund. To go to the next slide, to wrap up, I just view it as a fundamental bottom-up global stock picking fund. We're focused on understanding change and innovation in the world, and it has delivered strong risk-adjusted returns over time. Thanks.
Thomas, thanks for your time. I know that's a bit of a rush, 10 minutes, but and I also know how passionate you are about this space and have been for a long time now. How do you filter your ideas? I mean, it is such a broad scope in terms of what you look at.
Yes.
How do you filter all that noise?
Yeah, I mean, that's what I love about global investing. There's like $10,000 billion companies. There's so much you can look at. So really, we have a process on my team where we go through ideas very quickly. So we can get through an idea very quickly to work out if there's a lot of potential upside. We do pay attention to particular areas of innovation. So, when something comes along like, machine learning, we'll spend a lot of time on that. The space industry's had a lot of change lately. Only a few companies on the listed side there, but we'll look at that to try to understand what's going on. Drug development, mRNA vaccines, we spend a lot of time on. So we have these kind of top-down areas we will look at. But then what drives the portfolio is really this kind of bottom-up fundamental process, like what's the value of the company, is it cheap, etc.
There's a question here: how different is your process from Kathy Wood at ARC?
So, there are a few differences. I'd say, we are a lot more global in nature. Their holdings tend to be a lot more US centric. I'd argue we're a lot more valuation centric as well. So we're not really playing big themes for the sake of it. It's more around, can we find cheap stocks? But here are the areas we're paying attention to because we think there's a greater chance we'll find cheap stocks in those areas.
And where does China fit in the equation, given there's kind of been a bit of crackdown on some of the tech platforms, as an example?
Yes, so China is interesting. I think China has been an important market. We have had up to about 10% of the fund in China in the past. We've recently reduced it. I think some of the regulatory crackdowns recently have gone further than I expected. So, there is a risk on the horizon there that I think needs to be properly assessed. We do have a big position in a company called Joy. I think that's quite interesting. In the previous slide, I mentioned that as China/Singapore because their core business, YY Live, is a live streaming business in China, but they have agreed to sell that to Baidu. Once that deal closes, they'll be trading below cash value, and the residual asset you have is actually a global live streaming based in Singapore. So I think that's actually really interesting because it's come down with a lot of the other Chinese stocks, but I don't think you'll have that same risk.
And what are the kind of key themes you're looking at in terms of moving forward? Is it AI? Is it data? What are you looking at?
Yeah, there's quite a few. So AI is definitely one of them. I'd view Opendoor as an AI company. We've looked at NVIDIA in the past, etc. Renewables tends to be a big space we're interested in. I think there's an ongoing trend to that. E-commerce. There's quite a lot. Some more emerging spaces are things like VR and AR. I'm quite optimistic around the future of that, even though it's been a bit slower to take off. So there are quite a few themes like that we're excited about.
And is there any plan to have a listed product? There's questions here. How does an investor get access to your fund?
So at the moment, it's just through the directly to Perpetual. We are on a number of wrap platforms as well. That is something we'll probably look at.
And a clever question: what sort of technology do you use in terms of your stock picking process?
So we do a lot of the. So on the technology side, I guess one thing we've added in the last few years is a lot more kind of data scraping and data analysis because there's a lot. I talk about digital footprints. This idea that a lot of companies have a lot of public information out there that people aren't utilizing. When I made Zoom a really big position, one thing we did the proper analysis, we did our modeling and so forth, but I want to get a sense for the large customers that they were picking up. As it turns out, large customers tend to have their own subdomain. So Nike will have nike.zoom.us. So we actually went through the process of guessing the subdomains of the S&P 500 companies, looking up if they existed, and then that gave us better confidence that they were in fact signing up a lot of these enterprise customers. So I mean, that's one part of it. We track a lot of job ads for a lot of companies as well. Job ads can be a good indicator of what a company is going to do in the future before they've announced it. So we actually do a fair bit on that side of things.